But we start with a new wave of COVID concerns. The broader market on edge today as Austria declares a nationwide lockdown and Germany puts new restrictions in place for the unvaccinated. Back here in the U.S., new cases are starting to tick up. The 7-day average is up 31% in the last 2 weeks. The news putting pressure on the reopening trade. Cruise lines down nearly 8% in the past 5 sessions. Casinos, airlines, and movie theaters also all seeing big losses. What worked this week? Good old tech. The Nasdaq closing above 16,000 for the first time ever. So let's break down the real risks to the market. Guy, what, if anything, do these new COVID headlines give you as far as worry? Are you concerned? Why are we selling off now and not before? Is it just a head fake? What's going on?
As a human being, I think we're all concerned, clearly, but our task is to try to talk about the market. And I would say that, you know, for better or for worse, the markets have learned how to deal with these COVID headlines. Now, you bring up correctly the sell-off in some of these names. Some of those names that you mentioned probably got a tad ahead of themselves, but I think the market will learn to shrug this off, for better or for worse. I'm sure I'll get added at Twitter for saying that, but that's just the reality. In terms of what is working, it's been working for a while. I mean, the big cap tech names that we've talked about seemingly forever continue to grind higher, and I think people are finding valuations in some of these names, like a Qualcomm that we've talked about, really interesting. So I think some names have acquitted themselves really well. I think there's been a bit of a rotation. I'm surprised at how poorly the banks have traded, but maybe that makes sense in light of what you just mentioned earlier.
Nadine, I saw you nodding. I know the viewers can't quite see you all the time, but what do you make of what happened today and how that plays into your playbook for next week?
Well, we look at the virus count. So, you know, we all woke up to headlines that Austria is shutting down and a number of European countries are, you know, their counts are making all-time highs. But look at the hospitalizations. They're at a third of the prior pre-vaccination peaks. And so, example, in Germany, the current case count is at 169%, the prior peak, but hospitalizations are only at 30%. So what does that say? That vaccinations are appearing to hold the line. And so at the current vaccination rate, 3/4 of the world will have vaccinated pretty much all of their adult population by year end. And so when we see these headlines about Austria or maybe Germany contemplating some rules, like, we just kind of fade that and say, you know, overall, we're in a much better position than what we've seen in the past. And as Guy said, from a human perspective, it's still troubling. It is worrisome. But from a market perspective, we fade that type of news.
Right. And of course, case counts are one thing. Hospitalizations are something else. It seems this vaccine does help very much avoid those hospitalizations and the worst case scenario for many adults. So that's good news. Dan, what do you make of the action today?
Yeah, I mean, listen, the S&P 500, this is the same conversation we had last night. There's a lot of really nasty action going on, but the market is basically unchanged here. Why? Well, Apple closed at a new all-time high today. Microsoft closed at a new all-time high. That's $5 trillion in market cap. Alphabet was trading a new all-time high this morning. NVIDIA, a new all-time high. You get the drill here. This is the same trade that's been going on for about a year. There have been a lot of rotations that we've seen. I know we're going to talk about energy. The transports were a bit of a disaster today. They can't get going. So there's a lot of parts of the stock market that don't trade well. Should oil and some of these other groups be reacting to this sort of headline? I don't know. I mean, I think that if you look at the Russell 2000, we're going to talk about small caps a little bit. Do they have any exposure to Austria? I don't really think so. 75% of their revenues come from the U.S. here. So the real concern, whether we're going to have further supply chain dynamics that are kind of causing some apprehension about growth going forward, I don't know. I mean, I just think that this is the problem here. The S&P 500, you're looking at the wrong thing if you're trying to figure out what the gauge is of the fear related to further COVID headlines. I think we're by it. I think we got to move on from it. And then the global economy needs to get reopened here.
Karen, what do you think about today's move? Overdone based on the news out of Austria? The small caps, I think, as Dan is right, had very little to do with Austria.
Yeah, I agree with that. As far as I know, very little to do. But I agree with what Guy said at the top of the show. So there's two different things. There's, you know, the human story, and that isn't really our endeavor. It's more, what is the market going to react in what way? And I agree with him. I think we're just getting inured to that story. And we also have, you know, data that shows that we can handle the virus much, much better. And so even if there is some slowdown, I don't think the market perceives this as, you know, a Delta variant. Hopefully we don't see another thing like that. But the market just looks at it as, for example, Boeing, they keep delaying the Dreamliner. The story gets less and less bad every time. And I think this is similar to that. We've seen this news, we've seen this, work out a few times. And so I think that big pullbacks on this would be an opportunity to buy.
Karen, I know that you were focused a little bit on the action in the banks. Anything that you want to point out to our viewers as we're looking into next week, the shortened trading week, what you saw today that may portend some action next week?
So I think that the banks sort of overreacted a little bit on this idea of economy slowing and rates moving to the downside a little bit. I think they're still very attractive. I think inflation's here, and so I think the Fed is on course to certainly to start tapering and then ultimately to start raising rates. And I do think there is some uncertainty around who the next Fed chair will be. I think if it's Powell, I think that the banks will do better. I think uncertainty hasn't been good for them, but I feel like they're cheap regardless of who ends up being the new Fed chair. So I like the banks. I think there's decent value here in a few of them. I own JP Morgan, Citi, Wells, and Bank of America.
And as we're talking about rates, if you think that rates are heading higher from here, Nadine, you've got a way to play it. So we've got Trade School in session. Nadine, take it away.
Thanks, Courtney. So today I shorted a bit of the TLT and the XLU. So that's the 20-year treasuries and the utilities, or alternatively, you could go long financials, and here's why. So number one, yields are down and bond-like securities are up. So we've seen financials get hit 4%, so that's the XLF, in the past month. So that's since October 22nd. And alongside long-term treasury yields, I was looking at the 20-year, declining about 5.5%. And then in a rhyming move, utilities, which is a bond-like sector, has been moved up meaningfully from the early November lows. And so is tech run up, as we just talked about, and with the NASDAQ at all-time highs. So that's number one, as you've seen this big move. Number two, the macroeconomic setup, short-term is positive for long-term rates. Our team believes that there's a growth, an acceleration of GDP and an inflation near term. What is that called? Reflation. So we think the reflationary trade still will be back in session soon. And that means there'll be upward pressure on long-term rates. And then the third is technicals are in your favor. As Karen just said, banks are down, the yields are down, and sometimes positions just get overbought or oversold. So when we see such a quick move in rates, we decide to fade that trade. So it's not as juicy as the last time I recommended this trade, but the TLT is at 11% discount, so implied volatility discount. It means that people are really complacent right now, not paying for protection. If you want the best short on the TLT, you could be a little bit more patient than me and short it if it hits 150 spot 80. And if you just want to go long and don't want to do any shorts, again, kind of like Karen said, financials are overdone in terms of the downside. You could just buy the XLF. So there's some trades for you if you think that rates are going up.
I like it. Guy, what do you think about Nadine's approach here?
I think it's great. And last time Nadine talked about this, 10-year yields had traded down to 143 inexplicably, and she talked about that. And a week later, maybe less than that, they were north of 161. So that worked out really well. Obviously, we haven't seen rates trade down to that level, but I think her thesis is spot on. Again, I can't really say why rates are down here. Maybe Karen sort of hit the nail on the head. This Lael Brainerd news maybe spooks some people. I get that. But for all the things that I'm watching, 10-year yields should be significantly higher than they are now. So I think she's spot on with her trade.